You can't find a single successful trader that doesn't use multi-time frame charts in his or her trading. Even the fundamental traders try to participate in bigger financial movements with analyzing the lower financial data. So if you want to be a successful trader or investor, you should always keep your eyes on the bigger pictures of the market so you keep yourself on the right direction. Today we want to talk about multi-time frame analyzing and multi-time frame structures, so watch the video until the end. I have a big surprise for you at the end of the video, so watch it until the end. With liking, sharing and subscribing to my channel, you help me a lot to provide you with better contents and in lower time intervals. Hi, how are you? I'm Mehran, your trading companion, and today we want to talk about multi-time frame analysis and multi-time frame structural point of view. I post daily markups of main assets of Forex and cryptocurrency every day in my Telegram channel. You can find the link below. Those markups are quality markups. They get rejected very well, so you can use them for your daily practices or use them for learning. First, let's talk about fractals and multi-time frame and time frames. Then we can talk about multi-time frame analysis. What is time frame? A time frame of a chart is the smallest fraction which that chart is made of. For example, if we are seeing a candlestick chart, for example, let's see it is an hourly candlestick chart. Those candlesticks are showing us the movement of price in a time frame of 1 hour. So every single candlestick we can see here, for example, is a 1 hour movement of price. And the 1 hour candlestick consists of 4 15 minutes candlesticks. They are not necessarily 1/4 of the 1 hour candlestick. They can be bigger and smaller. For example, this candlestick can be from here to here. This candlestick can be a red candlestick to here, and this candlestick can be from here to here. And this candlestick, for example, can have a long shadow which makes the shadow of this candlestick as well. Let me see. So this is the concept of time frames. For example, here we are seeing 1 hour candlesticks. If I put a line here, sometimes the opening and closing hours are different, but if I put a line here and put a line here and go to 15 minutes time frame, there are 4 candlesticks between these two lines. Why? Because 1 hour is 60 minutes and one 15-minute candlestick is 1/4 of that candlestick. So it is the meaning of time frames. What are fractals in the market, and what is the point of using multi-time frame structures or multi-time frame patterns or multi-time frame analysis? The fractals in the markets are telling us that the bigger pictures, the bigger patterns, the bigger shape of movements of the markets are made from a smaller same concepts and same repeated patterns. For example, here we have a support and resistance zone here. The market went up, rejected from that, broke that, and we have a breakout pullback here. So we have a support and resistance zone here. What we have in lower time frames here is a kind of fractals. For example, we can see that if we use this zone here, and for example put it under a microscope, we can see that the market is moving like this. The market is coming down and the market broke some kind of support and resistance and went up. So the concept is the same. You can see that we have a support and resistance zone here, and it acted like here. The market was going down, the market bumped into something, it went up, it broke the resistance level, it pulled back to it, and it rejected from it. For example, it is a 1 minute time frame. For example, it is 1 hour time frame, and it is a 5 minute time frame. And those concepts are the same. It's just the smaller picture of this bigger picture that is repeating itself in higher time frames and lower time frames. It's the meaning of fractals or multi-time frame structure or analysis. For example, here we have some kind of support and resistances. It is a good level here, and if we go and see here and here, we can see that it's the repeated kind of this pattern. For example, here we have a support level that rejected the price, it broke the support level, it rejected from it once, and it rejected from it twice, and the support became resistance. Let's see these concepts in lower time frames in these two places. Let's go to 5 minute time frames, and you can see that it's happening right here. If we can zoom it, you can see that we have a support resistance here. The market came down, rejected from it, it broke it, and it come down, it became resistant, and it went down. You can see that it is happening in lower time frames. It's exactly like we had here. And here we can see that what is our best point of support here. It is here, and I'm going to talk about this, and it is here. I don't know if this point works as well or not, but we have 2 points of interest. Why this is important? Because if I continue it to the left, we can see that it rejected once, twice, 3 times, 4, 5, 6. Even here it is some kinds of rejection of this level. Here. Yes, it is not 100% accurate. For example, here it broke it and it went up, but it is very high probability and we can rely on it. And here is the first rejection. The second rejection, I think it is going to be here. I don't know. Really, I don't know if it is. Yes, you can see that here. So the fractals of the market are the patterns that we can find in higher time frames that are going to repeat themselves in lower time frames. I should note something here. What very important thing is that those repeating patterns, those fractions, those fractals that we are talking about, they are messier in lower time frame. So if you are using very low time frames like seconds or 1 minute or even 5 minute time frames, you should be able to read a more messier chart. For example, it is a daily chart and it's very beautiful. All those support and resistances, many of those support and resistances get respected and rejected. But when I go, for example, 1 minute time frame, you can see that it's much messier and it's much harder to read. If I go to 15 seconds, you can't even read these kinds of charts. So you should choose a time frame that suits you and your characteristics. So let's talk about the structure of the market. I talked about the structure of the market in this channel a lot, but we are going to summarize that and we are going to use that in multi-time frame concepts. If you've watched the previous videos on the channel, you know that we have something named break-off structure or BOS. What that means that we can find our protected structure and targeted structure with this concept. The market is going up, it comes up, it breaks this structure, it breaks this high, so it needs a lot of money a very big amount of money to come back and break this structure. Why? Because anyone who is moving the market, who has the ability to, the knowledge and the power and the money to move the markets, have decided to break this structure, and he can't allow you to make their numbers negative. So if the market is coming down, the least thing that the person who is moving the market can do is that he is not going to sell the market here. He is going to keep some of his positions. So the market retraces. It is a protected low. Why? Because we broke the high, and it is going to continue its movement. Most of the time we have some point of liquidity here. It is a new concept that I'm just pointing out here, but the basic concept of market structure and break-off structure works in every time frame, in every market, in every assets. So the market came up, it broke its structure. After that, it starts to retrace. It breaks the structure again, it starts to retrace, and we, as a good reasonable trader, will assume that the market is going to continue its movements for ages. Let me show you. If the market is going down from top left of your monitor to the right down of your monitor, it is going to do that forever. You can see that it moved for 23 days, especially if you are a day trader, and you can see that it is the continuation of some months movement. You can see that it is the continuation of 221 days of bullish movement. So when we have a market going from down left corner of the monitor to the top right corner of the monitor, it will continue its movement. And break-off structure is a very powerful concept that helps us to use these movements, and we can measure these movements. We can measure the pullbacks, and we are going to talk about that in this channel. So let's say that the black is 1 hour chart, and the red or the pink, I think, is the 5-minute chart. What we have here, we can see these bullish movement and these retracements in 1 hour time frame. But if we go to the 5-minute time frame, for example, we have this kind of movement. I love this pink color. It is going to do something like this, for example, a fake shift, and it is going to go up. I'm making it very simple. The market movements are a little bit complicated, but I'm going to just show you the simple way. It comes down, it breaks the structure, it goes up. For example, it is a 5-minute movement, and it breaks the structure to the downside, it breaks the structure to the upside for liquidity grab. It comes down and it continues its movement to the upside. So we have many kinds of structural points of view in every time frame we have up here, but we are going to talk about 2 time frame analysis and 3 time frame analysis in the near future. So we just are going to start with 1 hour and 5 minutes. There are a lot of time frames here. You can't go and, for example, analyze every time frame there. It's just going to make you crazy. So it is one leg of bullish time frame, bullish movement in 1 hour time frame. But if we go to lower time frames, we can see that this wave is made of some ripples, for example, and it went up, it went down, it went up, it went down. And if we go to, for example, seconds time frame, we can see that we have something like this, and it is going to repeat itself in every time frame in lower time frames and its higher time frames. So the market repeats its patterns in every time frame. Anyway, we can use these concepts in these time frames as well. For example, a very simple entry setup that you can find is 1 2 3 setup, and it is 1 1, 2 and 3. So it is, this low is 1, this is 2, and this is the 3. We try to trade continuation setups, so we have this movement, we have our break-off structure, it is the retracement of this bullish movement, so we are going to find our bullish 1, 2, 3 setup. For example, here we have 1, 2 and 3. This high, this low, and this break is our number 3. So we use the higher time frame concepts in lower time frame concepts to increase our win rate and our reward to risk ratio. For example, if you have a big order block here and you have a big order block, for example here, let me clean this up. If you want to just enter on order blocks in a movement up or in a movement down, there are millions of order blocks that don't work. Why? Because you should have some kinds of confirmation or entry setup. Anyway, if you just order on order blocks, you are going to have a stop loss here, and for example, let's say this order block is a big one, and you will have a very large stop loss here, for example. But if you take entry setups, first you are not going to get a stop loss here, and you can enter, for example here. For example, we have an order block right here as well, and you can enter here on this order block, and you can put your stop loss here. So your win rate will increase, your reward to risk ratio will increase, and especially your confidence in your trading will increase, because you know what you are doing. You know that if an order block is going to work, you have some kinds of confirmation that you can use on that order block. And what are we using here? For example, this simple 1, 2, 3 setup. We have just a break-off structure here. We have a break-off structure as our confirmation. So again, the market is going down, it broke this structure, so we are going to wait for retracement. For example, we have another big order block here, and we don't know where to enter. We are waiting for something named 1, 2, 3. So it is 1, it is my 2, and it is my 3. You can enter right here if you are confident enough on your trading strategies and your order blocks, and the zones you are using, it doesn't change with support and resistances, and other zones they all are good. But if you use order blocks, you can enter right here, or you can find some kind of valid order block in this leg. You can enter, for example, here and put your stop loss here, because most of the time markets will react to imbalances or liquidity points or order blocks. It's one of the three. So it comes down, let me show you, let me say it is going to come to here because we have a support and resistance, or we have a breaker block here. So it comes down, you can enter here and put your stop loss here. But if you wanted to just trade this order block, first you will have a lot of order blocks in this bullish movement, but you would have to put your entry setup, for example, here, and this is the difference. It is just a 1-to-1 reward to risk ratio to this high. That is our first target, but here we have a 1 to more than 2 reward to risk ratios as our target. So the multi-time frame analysis, or multi-time frame a structural point of view, helps us with increasing our win rate, increasing our reward to risk ratio, and increasing our confidence. We talked about the importance of the multi-time frame structure and what does it means, what does time frame and multi-time frame means. And now we are going to talk about a very important thing that is named the higher time frame structure and the internal structure, or you can say that it's external structure and internal structure, but I just call them higher time frame structure and lower time frame structures. If you have seen my playlist is in this channel, you can see that every piece that I'm talking about is connected to each other. I have a point to teach you these concepts for the future. So if I'm naming these things, the external structure or the higher time frame structure and the internal structure, I'm going to do something with this and with you in the future. I'm not just those gurus that like to name things and they don't have any use for it. So when I say that it's internal structure and it's higher time frame structure, you should know that, you should memorize that, because in the future I'm going to use this. I'm going to use for example internal structure order blocks because they are higher probability order blocks. I'm going to use internal liquidity. You should know the internal leg of a price movement. For example, these retracements are the internal movement of a price leg, and these ripples that are pink are internal structures. So you should memorize them and you should practice them on your daily practicing and learning about the markets, because I'm going to do something about them in the future. Anyway, so this bigger picture that we can see, it is like a high road. It is our higher time frame structure, and these movements that are like cars that are moving in that high road is our internal structure. Why is that important? Because for example, if this is our 4-hour structure, we can, let me point that out. For example, if it's our 4-hour structure, we can start to trade these internal structures and these internal, for example, points of liquidities and setups toward that higher time frame structure. Or we can trade these kinds of movements to this high and even higher than that high. So our higher time frame structure is going to be this black line, this bigger picture, and our internal structure is going to be these ripples. And memorize these names, because I'm going to talk about the lower time frame structures as well. Those are not internal structures, for example. So it's important to learn these concepts right. I don't say right here, right now, because you should go and practice them, but you should learn these concepts in this episode. Let's memorize it fast on charts, because this episode took too long. Anyway, it is our 4-hour structure to the downside, and I'm going to use the black line to point this structure out. You can see that how simple is higher time frames for trading, but because of commissions and because of our limited patience and because of the fast movement of the world, the fast connections of communications, the fast smartphones, we don't have the patience of a 70 years old investor. So we are using lower time frames to make daily trades and make more trades maybe, or increasing our win rate and our probability and our confidence. So we are going to lower time frame and we are going to mark the 15-minute time frames with the color pink. I'm going to record some of it so you can see the difference. It is black. Let me change the color. I don't have an editor, so thank you for your patience. I'm just going to show you the simpler and the more clean structures of these time frames, and you should practice these concepts like what I'm doing right now. So you should go and you should mark your higher time frame structure and lower time frame structure. That will help a lot to grasping these concepts. If you see, I'm just worried about the break of the structure. I'm not going to mark these ripples because my primary structure, you should remember the primary structure. I talked about that in the previous videos. My primary structure is from here to here, so I just draw this line because this line broke this structure. So I'm concerned about structures. I'm not concerned about the messy movements of the markets. I'm watching the structure of market and I'm marking that out. We can see that here the higher time frame is like the big waves, and those lower time frame structure is like ripples on the water or ripples on those waves. I had a surprise for you and I waited until the end of the video for sure, so you watch the whole video. Anyway, I'm going to make a lot of free contents for you, semi-free contents for you. I'm going to post daily markups for totally free for you on that Telegram channel. I'm going to post some of these videos on that Telegram channel, so you have maybe easier access to those videos. And I'm going to do some webinars, do some ask question webinars, question and answer webinars, and some other webinars for example, how I mark my charts on a live chart or how I trade maybe in the near future. So you can subscribe to that channel. I'm putting the link here for the Telegram channel. Most of my works there is going to be totally free, and my private course is going to be free for active traders. Not my mentorship, my private course. Mentorship takes a lot of time. My private course is going to be free for active traders, those traders who have the determination, have the motivation and have the discipline, so they started live trading and they are putting in some works. I'm not saying profitable traders, I'm saying active traders. Profits will come in the long run anyway. So my private course is going to be free for those active traders as well. You can DM me on my Telegram channel. I'm going to put my private direct message account there as well. So much of my work is going to be free, some of it is going to be semi-free. And for mentorships, because it takes a lot of time for one-to-one mentorships or group mentorships, it is going to be I'm going to charge you a little bit. So subscribe to the channel. My markups, most of the videos and a lot of other things are going to be free there. Thank you for watching this video. Use your multi-time frame analysis and multi-time frame structural point of view on a daily basis. It is going to be very powerful and very beneficial for your tradings. With subscribing, with liking and sharing these videos, you help me a lot. Thank you and have a very amazing week.